Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and also Portfolio Manager. Thank you for giving us a few minutes of your time where we're going to talk about some of the things we hit in this week's investment allocation meeting, including talking about inflation-protected securities and checking in how they've done in this inflationary environment. We'll talk about credit ratings, something we don't hit a whole lot, but something I found surprising and we'll share with you. Talking about the strong labor market dynamics after that big drop last Friday and some aspects of that report, and then a drawdown retracement where Andrew will guide through a pretty long period of history going back to 1900. So stay with us through that. You won't be disappointed. But let's start off with inflation-protected securities. So if I were to sit here and tell you in, let's say, December, that the following year we were going to have not only inflation stay high, but move even higher and have one of the strongest inflationary environments that we've had in a very long time, you would think that something that's labeled inflation protected or a treasury inflation protected security would have a great year. That would make some pretty common sense. What this chart is showing you is the performance of treasury inflation protected securities. So those are bonds issued by the federal government that roll up and have a return that coincides with inflation. You're looking at the total return for these in each and every year going back since their issuance. And what you find is that only 2013 was worse. Just kind of stunning when you think about that, unless you look underneath the surface and think about it in terms of what it actually is, which is a bond. And it is impacted by changes in interest rates. So just like all the other bonds, it has been hurt. So maybe it's held up a little bit less than some other bonds, but just thinking about how you would protect yourself from inflation, they have been far from the best way to do that. And instead, as we have here at Financial Enhancement Group, have relied on different instruments. We've relied on energy stocks. We've relied on more commodities and other things that have held up better in this environment. Pivoting now to talk about credit ratings. So there are two major agencies that are responsible for rating bonds, S&P and Moody's. And they review periodically the issuers of this. So think about the companies in the United States. They review these companies and their financials, and they're either going to be saying, hey, they're getting better, they're getting more creditworthy, they're going to be more likely to pay you back, or they're getting in worse shape and we need to change their ratings down. You'll be less likely to get your money back. This chart is plotting those two ratings agencies. The green is the total number of companies for whom they have upgraded the ratings. The red are the number that they have downgraded. So obviously you want to see more green than red, like so many other charts. And what you find, and this is just surprising, at least to me, that we have just come off of 2 quarters of negative GDP. Last week, we kind of talked about the subtle differences of recession or not recession. But the fact of the matter is we have seen at least soft GDP, if not negative. And in that environment, we have seen the credit rating agencies do nothing but firmly upgrade the companies in the U.S. So what comes of this? Maybe they're wrong and companies have not improved their credit worthiness, but I think it's worth a pause, and it is one good point to see the underlying health in the companies, because after all, as Andrew is really good about reminding you, there's a difference between how the overall economy is doing and how your underlying investments in the market are doing. Those two things can be different. And so we see a lot of companies that are still doing quite well. So staying within that economic realm, though, Andrew, you brought to the table this labor market dynamic. It was a whopper of a report. What we put up here.
It wasn't.
Go ahead.
Yeah. In reference to the credit ratings, luckily they got 08 and 07 so correct, and they did such a great job at warning about the credit agencies on that debt. We can always trust when they start upgrading and downgrading companies. They just have an impeccable track record. Of course, I'm being very sarcastic. But anyway, moving on, looking to the labor market. We did get the latest jobs number at the start of every month. We get the jobs report from the prior month. So now we're looking at what happened in July. And the labor market's extreme. It's always important, but it's very important right now because we're seeing the Fed, and something we've talked a lot about, the Fed has been adjusting interest rates. If we want to remember, the Fed's job, the mandate that Congress gives the Federal Reserve, is regarding the labor market and inflation. And they try to have to balance both of those pieces of data. They want to have a very healthy labor market and they want to keep inflation under control. But when you start messing with one, it does have an impact on the other. When they start raising interest rates, that can begin to tighten or suppress some of the economic growth, which could have knock-on effects to the labor market. So right now, we're always very curious to see what's going on in both the inflation data and the labor market. And for July, it was a very, very strong report. In fact, the jobless rates were actually two times better than what Wall Street was expecting, over 500,000 new jobs. And looking at the unemployment rate, that's the chart we're looking at here. It actually ties February 2020, so right before the COVID crisis, as being the lowest unemployment rate since 1969. Really shows how strong the labor market is. So we take all this data, we recognize we have a good labor market. Is this a good thing or a bad thing? And actually, we could probably make the argument for both. Quickly, it's a good thing because when we have a lot of people being employed, that's great, not only for consumers as they have more money to spend and stimulate economic growth naturally, which is always what we prefer. But on the other side, it can be a negative thing because it will cause the Fed to kind of be a little bit more emboldened, realize they can maybe be more aggressive or just as aggressive with raising interest rates, recognizing that the tightening that they have started to do has not begun to have a negative impact on the labor market. So we'll see as we go into the next Fed announcement whether they start to discuss this more and really get a little bit more confident, hopefully not overconfident, in their raising rates path that they've been on so far this year. So we'll do a shift here from looking at the economy. Now we're going to shift over to the stock market. As you guys know, my favorite topic to discuss during the market carver. What we're going to do, and one question that we get asked a lot, is at what point do you know that the downturn is over? When do we give that all clear sign? I wish it was that easy. And something we often discuss, say it's a stair-step process. We start looking at different price levels. We start looking for different signs within the market. We've talked about breadth thrusts and improvement in market participation. And we also look at the amount of recovery from a decline. And as a technician, something we always look at is 50% recovery, meaning that the market goes down X amount of percent, then we want to see when it recovers half of that loss after dropping at least 20%. That's typically where we don't see the market. We get a lot more confirmation that that prior low, in this case it would be in June, is a durable low, meaning that the market has really shown a lot of strength. It's being able to recover half of the decline. And this is a chart, a really long chart of the Dow Jones Industrial Average showing just that. This goes back to 1900. So you can see on kind of the middle to far left section, that big decline, that was the Great Depression. If we look a bit further to the right, we can see it appears compared to the Great Depression, a much smaller, but still very dramatic. The dot-com crash, financial crisis, the last 10 years, it looks very small now, the COVID crisis there. But the blue arrows on this chart, what we want to talk about right now is when the market's gone down 20%, we've checked that box so far this year, and then it's recovered half of its decline, where the market gets into about 0.5% of recovering half of the decline. And you can see that's kind of where the make or break points for a lot of markets are. During the Great Depression, they had that recovery, and then the market rolled right back over, and things got a lot worse. But many other times since then, we've seen that recovery of at least half of the decline, and the market keeps chugging higher, confirming that there really is some good bullish strength in there. Then if we look a little bit closer to the dot-com period, we did have a really strong counter trend rally. The market bounced higher, but it was unable to continue past that 50% threshold, and it did roll over and continue to decline. We actually never had a period that matched that criteria during the financial crisis. And then once again, we did have that happen again during the COVID crisis, where the market dropped, saw a big recovery, and then obviously it continued to go higher into 2021. So right now we're seeing about 2.5% is where the market is right now from reaching that 50% threshold of recovery. So we're keenly watching that. The market this week has been, so in the early part of this week, a little bit on the downside, pulling back from some other key levels, but we're about 2.5-3% away from seeing that 50% threshold, and we'll really be able to get a better idea, is the market ready to start continuing to rebound, or is this just a short-term bounce and we could see some more weakness going ahead? We'll have those answers hopefully in the next couple of weeks, and maybe it'll be another topic for a market carver, but it's definitely something the allocation team is closely watching, monitoring, and discussing as we make adjustments to your portfolios.
Well, it certainly has been. We're always inundated. We're always pouring through lots and lots of data, but this seems to be one of those periods where it's more than usual. There are more key levels, more key data, whether it's inflation or jobs, retracement levels, so on and so forth. But that's what we're here for, and happy to keep going through those on a weekly basis. And we'll continue to update you and share those with you as we find them. So thanks again for giving us your time. Please come in and see us if you haven't for a while, or you may be meaning to give us a call, schedule your update. Please do 800-928-4001 or scan the QR code. It'll set you up with a link to get with us. And also don't forget about the radio show, which is every Saturday live on WIBC or however you get your podcast. So thanks again and have a great weekend.